My guest today is Roman Khan, a founder and president of holding company Peak 21, where they buy, grow, and sell 10 to 50 million direct-to-consumer businesses. Today, they have 300 plus employees across brands, 4 offices around the world, and generate 200 million in sales profitably. Thanks a lot for coming to the HoldCo Builders podcast, Roman.
Thank you. Thank you for having me. I'm excited to be here and hopefully I have something to share and it's not too boring for your audience.
No way. Well, it all started for you in 2013 with $20,000. You started selling luxury handbags at cheaper prices. You said in your previous interview you were too naive to do that. Please tell me more about that time.
Yeah. I think 2013, I'd already done e-commerce for 2 to 2.5 years for incubator called Rocket Internet. So Rocket Internet, for those of you who don't know, it was started by the Semver brothers, really interesting brothers. They cloned everything in the US, brought it to the rest of the world. So I was part of the team cloning Amazon and Zappos in Southeast Asia. So I've already seen a business go from a couple of hundred orders a day to a million orders a day. So I was already convinced that e-commerce was where I was going to spend my whole career. 2.5 years into my career with Rocket, I decided to leave and start my own brand with my wife, Jen. So she actually built the brand. I didn't come up with the idea of linear. I needed the briefcase for work. I was a CFO for Lazada Thailand, like the Amazon clone in Southeast Asia. And my wife actually made me a briefcase because I was trying to buy a briefcase for myself, a leather one. I couldn't find something that was minimalist, that didn't have a big flashy logo, and that wasn't covered in gold. So she was a board management consultant. She had quit her job, moved in with me in Bangkok, and she just decided to make me one. So she found factories, made me one, and we kind of just snowballed into launching it on crowdfunding. I think our first crowdfunding campaign did $140,000 in pre-orders or something along those lines on Indiegogo. And we kind of stumbled into it. So it's a classic example of what Justin Khan at Twitch said. He said that first-time founders fall in love with the product. Second-time founders fall in love with distribution. And I think we fell into that trap. So leather bags online are problematic for many reasons. One, obviously the TAM, the addressable market is really, really big. And the growth at that time was decent. You know, you have a multi-teens, billions of dollar bag market growing. I know what it was growing, right? What the CAGR was, but it was not zero or negative. But it's a very subjective purchase. It's a very considered purchase. It's a very expensive purchase for most people in absolute terms, even though we were a quarter of the price of luxury brands. It just required a lot of convincing to get someone to buy it online. So, you know, I think founders don't talk about luck, but, you know, the fact that we launched this in 2013 is the only reason we actually were able to crawl our way to $1 million of EBITDA 2.5 or 3 years in because of cheap digital advertising. At that point, people had not really adopted D2C yet, spent a lot on Meta. We were a large D2C brand outside the US. It was like the early wave of D2C. And to be honest, I think like if we had started with now linear only sells jewelry, it's 99% of sales. We're sunsetting the bags, we're sunsetting the watches. It's like we did 3 pivots to get to jewelry, you know, and it's like now with just jewelry, if you forget bags and watches, because we don't even look at that revenue anymore. We're just selling through the inventory. We'll probably do 50 million plus this year with very healthy profit margins, right? And I think if we had started with jewelry in day one, we would have done 500 million this year. You know what I mean? Like, it's just like the characteristics and economics and repeat purchase behavior of that category versus bags is night and day. So I think that's what I mean when I say, you know, being thoughtful about your category is extremely important. In e-commerce, unfortunately, I hate to say it, category is much more important than team. You know, obviously the combination creates outlier successes, but you know, in most cases, I've seen young founders. You know, when I'm a mentor pass, I had this kid. I have 2 kids in Dubai, both Italian actually, booking me separately. But you know, one of them is spending $100,000 a day on Meta, and it's his first year of business, and the other guy is spending $200,000 on Meta. and they're just blowing through inventory the roof. And they're insanely smart guys, right? Insanely smart, but they have nowhere near, they haven't spent 12 years in ecom, and they're going through these like pitfalls, and they're smart enough to reach out to people asking for advice, but they picked the right category. So I think that's what I mean when I say that. And but yeah, I'm really grateful for Linear. It's still actually what we're kind of known for as a group among, I would say, very important people, like, whether it's investors, debt providers, celebrities, whatnot, it caters to a very important clientele. And I think it owns the mind share of a very important person. Even though Raycon is, much larger, it's an interesting brand to have in the portfolio.
Okay, the Raycon story. I mean, 2017, you had 1 million in EBITDA, and you started using the balance sheet and earnings from Linger to acquire other businesses. What about the story of your wife firing you and saying, go look for other companies to acquire?
Yeah, great research. So yeah, just to recap, taking 2, 3 steps back, I was at this job, Rocket Internet, really tired. I was getting burned out. I was 27 at the time, I think, or 26. I can't remember exactly. Bad with timelines, but I had thousands of employees, and I was so stressed out. And I think that's when I started losing my hair. It was like really, really, really intense work. And my wife and I took turns working a job until 2017 or late 2016. So my wife went to work for Square prior to the IPO, the Jack Dorsey payments company, for those of you who don't know, outside the US. And by 2017, we were on, steady footing. And what happened is, I think, was hubris and ego. So 2017, we were starting to make real money with the business. And I started thinking, I was, the Einstein of DTC, right? So you start taking out really large cash flow dividends, thinking everything is going to continue to go up towards the right. And it continued to grow, but I completely misforecasted where the demand curve was. So we bought way too much inventory. And at that time, I think watches was maybe 60, 70% of our sales. We probably had we had a Kickstarter campaign doing 1 million just in watches, right? Like, so it was, we had really strong product market fit in watches. We thought, I don't know what the numbers were, but I thought we were going to 5x or 6x. So we bought inventory accordingly, and production lead times were 6 months, and we didn't understand our free cash flow. So all of a sudden, it was a little bit like Titanic. We had this mountain of inventory coming our way, and the boat was like going to crater into the iceberg, right? And I could see it from a mile ahead. So it was really stressful. My wife and I had to take on personal debt. It was really, really, really crazy. At the time, we were supporting our families, so our parents, financially. So we had that additional burden. And I remember at the time I was waking up anxious. It was like I had weight on my chest. I was just like, oh my God, this is a disaster, because my return on ad spend can't support more spend. I didn't really know what I was doing compared to now, right? Compared to now, I spent hundreds and hundreds of millions of dollars on these marketing channels. At that time, I hadn't managed that spend myself to that scale. We almost went bankrupt. And I remember my wife and I signing loans of 7 figures with a personal guarantee. It was really interesting. I remember we made a slide deck, 5 slides, where the punchline was I am an idiot. I kind of want to find those slides again and kind of print them out for the office. But where I said, I'm an idiot, I made a huge mistake. I think I took 1 million dividend out. I spent 300K on crypto. Lots of it I lost, 300K on random stuff. I was just stupid, I think it just got to my head. And we made these slides, and it was so jarring. And we had to go back to first principles thinking, like Elon Musk always says, right? And we could see that there were light at the end of the tunnel. Yes, we had ordered too much inventory, and that's when we picked up, before, what's the negotiator guy called again, Chris Volk or whatever. We started reading his books before everyone started reading them, right? We bought a bunch of books in negotiation. We're like, okay, we need to negotiate with our supplier. We need to negotiate with our credit facilities. We need to talk to people about raising money. This slide deck was just me saying, we made a ton of mistakes. This is how we're going to get out of it. And I was privileged enough to have enough professionals who believed in me earlier in my career, because at Rocket I did quite well. And there were people who saw my rise in that career who were willing to lend me six figures. And we found like banks and whatnot, and we were able to scrape together, close to seven figures, I believe, with a personal guarantee. And that's when my wife turned to me and said, like, you need to work on something else. We can't be both in this boat, sinking ship. And it felt like a sinking ship at the time. And I think honestly, if you came to me and you said, I'm gonna give you $100,000 and wipe out the debt for Linear, here are the keys, I would have taken that offer. So I think that's when I started to look outside. And Ray from Raycon, the founder of Raycon, reached out to me maybe half a year before we were going bankrupt. Don't quote me on this, but I think like approximately. And he reached out to me and they said, like, I want to start a leather shoe business. And I did a call with him and I said, these are 10 reasons you shouldn't do shoes. Leather is horrible, blah, 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 because of all my bias. Of course, he went on and did it anyways. And then that failed. And then he started Raycon. And Raycon was not taking off. I think he had like $300,000 in wholesale orders for the year, or like run rate. I think it was half a year into the journey. And he asked for my help, and I decided to be the agency of Raycon, actually. I didn't have the balance sheet to buy something, so I was the agency.
Raycon is the consumer electronics, just to be sure, right?
Yeah, exactly. So we sell wireless earbuds. If you're in North America or if you spend a lot of time on YouTube, you'll know us. I think on YouTube, we are by far the largest brand by impressions and views as a physical products company. I mean, obviously, we can't compete with Monday.com or SaaS businesses that have 100% margins. If you think about physical D2C products, I believe we're the biggest. We have more than 10 billion views over the past 6 years, and we're really dominant in that category. So I got involved with Raycon as an agency, traditional agency, charging something as a percentage of ad spend for cash flow. And I took a small equity piece in the business. And over time, when I took over the business, I wrote about it on my X, and it's the thread that's pinned on my profile. So you can find it in my profile or my highlights if you're watching this. But I talk about how I took the business from June 2018 from zero or $100 a day on Shopify to 7 million, then from 7 million to 32 million, 32 million to 72 million, and kind of just blitz scale the business. And it was on back of all those learnings, going back to the very beginning of this episode, is the Justin Kwan framework. I really want to focus on distribution rather than product. Ray had done a phenomenal job. His family comes from consumer electronics. So, they had a catalog of like 30 plus products. I killed everything and just focused on earbuds because I knew the CAGR was high. And I talk about that on X. I think it's worthwhile reading that thread, because that was really what allowed us to blitzscale, because I was really religious about what not to do rather than what to do. And eventually I took, a very large stake in the company. Ray and I are, the owners of the company now. We actually bought out Ray J over time because he wanted to go on and do a new creative project. Ray and I own the business now. We run it for cash flow, and we don't know what the future holds, but it's a very, very healthy business, and it's very, very large. And yeah, it's like definitely what I'm known for among people in the D2C community.
Another acquisition. These are the successes we cover. We will cover AlphaFo and Nutrition Kitchen, but you've said that you've made 3 to 4 other acquisitions, investments which did not work out. What were the lessons from those, if you can share?
So this is 2017 when Jen fires me, or 2018, early 2018, I think it was like Q1 or Q2. And then I started working on Raycon in Q3 2018. Then shortly after, I'm very close to Sam Parr, the founder of The Hustle, podcast host of My First Million. I was on the board right before the exit, so like, Sam is a very close friend of mine, and, I went to his wedding. So, him and Sarah are like, just like, it's really incredible. When I was in San Francisco, when Jen worked for Square, I was in a co-working space called the Founders Dojo, and Sam was there. Moise was there. I remember him walking in, 2 weeks after I moved in. It's like, hey, I'm Moise. I'm starting a deodorant brand. Like we were all in the same co-working space, and I think Jack Smith, like Sam's best friend, like came by the office. It was just like a melting pot. It's insane. If you Google Founders Dojo on The Hustle, you can see an article and you'll see me in the video. It's like really funny because I watched that video with Fahim, another guy, the guy who brought me to the dojo in the first place. But sorry, I'm digressing. So Sam introduced me to one of his investors and his friends and another fellow board member of The Hustle called Ramon Van Meer, and he's big on X. And he he's an incredible guy. He sold something called Soap Up, which I think is worthwhile reading and listening to the podcast. I think My First Million actually intuited him. So you should definitely watch that episode and kind of get up to speed on Ramon. But he had bought something called Sausage Dog Central and been able to scale it to $1 million before I even got involved. And we met up at the Hustle office because I was in San Francisco at the time. I don't know why, but I was there. And Sam introduced us, and Ramon asked me to come on as an advisor. So I got involved with the company at that stage, and I basically helped fractionally running, paid growth. But it was not like an acquisition; it was more like a sweat equity deal, the same way Raycon was. I didn't actually put dollars down. Subsequently, eventually, Jen and I moved back to Hong Kong. I'm shortening the story quite a bit, but like, I was in Hong Kong. I was working out at the gym that Josh, the founder of Nutrition Kitchen, owns, and he recognized me from Linear because I was appearing in the Kickstarter videos, and he had seen them. So he approached me at the gym and he said, like, "Hey, I own Nutrition Kitchen," and he knew that I was a customer. And the business was maybe doing 1.5 million US in revenue at the time. It was like really tiny. So all these businesses were like tiny, right? Like Raycon 300K, AlphaPaw, I don't know. When I got involved, maybe a million in TTM, if not less. And Nutrition Kitchen, I would say, is 1.5 ish. And that was a very happy customer. So Nutrition Kitchen is like Factor in the US, so ready to heat meals. And he asked me to get involved. So we looked at, I looked at the CAC to LTV and I decided to buy 12% of the business to start. He started with a bunch of family members and a chef. And over time, I went on and bought secondaries from 12% to 60% of the business by buying out this dead equity. Dead equity is a term for people who are just dormant, founders who are leaving. And over time, I bought 60%. And Josh actually bought more. I think he had like 30% and bought his way up to 40%. But that's how we got Nutrition Kitchen too. So by 2019, as a group, I think we were doing north of $50 million in revenue, on an asset level, right? But weighted average, right? Like I own 40% of Raycon, 60% of Nutrition Kitchen, 100% of Linear with Jen, right? Like, so weighted average revenue, I don't know what it was in 2019, but we were north of $50 million. But then what happened was COVID, obviously, in 2020. And it was really like the silver lining with COVID was that we had almost gone bankrupt in 2018. So we really knew what to do. And I think there's like, I saw this guy when I was on vacation in Thailand. He said like, luck is opportunity, like equals opportunity, and luck is grabbing the opportunity. And I feel like we had a faucet flooding us with luck in 2020, and we knew how to grab it because we had the bucket. And we had learned it really the hard way, like what to avoid, what mistakes to dodge, what to not do to ensure that we were executing well. And that is why Raycon scaled at the rate it did without raising any funding. Nutrition Kitchen 10x on the back of uh, this. Uh, you know, uh, the the Linear grew like tremendous amounts also. So like all the businesses just like exploded on the back of COVID. 2021, I believe, I don't know when Jen was in Forbes, but Jen got into Forbes 30 under 30, which I don't think is like, has a lot of merit, but whatever. The Yam family, YAM, Jeffrey's actually on X, so you should follow Jeffrey. He's a great guy. I don't know what his handle is, but I'll let you edit that in, Mick, like his handle. But Jeffrey Yam is the son of TC Yam, and TC Yam bought Forbes Media. I don't know when he bought it, maybe 15 years ago or something. This is Googleable. And Jeffrey happened to be at this Forbes 30 under 30 event here in Hong Kong that Jen attended, and we just decided to go. Like there was like drinks and some fancy hotel here in Hong Kong. And Jeffrey came up to us because he recognized Jen and me from the Kickstarter stuff and the Kickstarter ads and videos. So he was saying, they were really amazed by our story and our growth. Obviously, they knew Nutrition Kitchen because we have 90% market share in Hong Kong. We have 90% market share in Singapore. We're really dominant in this region, in this part of the world. And he was saying, he and his father were saying, like, we really want to invest in you guys. And at that point, Jen and I really valued our independence. We never had raised any money. Everything started with $20,000 in savings. We had rolled over the earnings from these other companies into buying additional shares in Nutrition Kitchen, etc. We politely said no. But if you ever come to my office in Hong Kong, you'll see like he came to our office probably 15 times consistently in a 2-3 week period. So he was there practically every day. And he was like, this, you should definitely go out and buy larger companies and you need an external balance sheet. And that's how Peak 21 was formed. So we raised a round. So when we talk to founders and our website, it's too complex of a story to tell. So we try to tell it briefly in the top there with the timeline. But the thing is that we have these first four companies that Jen and I hold on our personal HoldCo in some external legal structure. And then we have Peak 21, where still Jen and I own majority, obviously, but where we raise external LP capital and we use that to now buy businesses. And, you know, we've bought we've acquired 5 businesses. 2 of them are large, like where we actually had to put real money down, like 8 figures down. And the average size has been 20 to 25 million. So we don't really buy 10 million, to be honest. We say that just to keep the funnel open and allow for conversations with great founders early and build the relationships. But in reality, we're more buying 20 to $40 million businesses because it takes the same amount of time buying something that does 10 versus 40. So we try to lean towards larger acquisitions. So last year we bought 3. I'm going to get back to your question, Mick. This is a very long-winded answer.
That's all good.
But yeah, so we had like 3, we've had 3 failures, I would say. 3 failures. We've had more than that, to be honest. We've incubated stuff too. But one of the most recent ones I would say is, for example, No Beauty. So No Beauty is a business that we have with Vanessa Hudgens. So big celebrity. And,
Interrupting for a second. From which moment do you call it a failure? For how long do you give it the time or?
we don't have a definite framework, but, if there's a quadrant, right? Like, so if something is large and you have small, and then you have no product market fit, anything in the left bucket has kind of failed. And I don't think it's because of my team or the founders that are involved in the business. It's just that everything is so large now that it's so hard to, the revenue Raycon does in November is the same amount of revenue Nutrition Kitchen does the full year. So, it's just the numbers are just so crazy, right? Like it's just so insane. The EBITDA of Raycon might be, half or the same as the revenue of Nutrition Kitchen, right? Like it's just like so it's just becomes this thing where you focus less and less on your kids. That like the smaller ones, right? Like I have 2 kids, like I can only imagine if I have 4, right? Like the attention just gets divided more and more. So I think failure would be like we stop focusing on it, And with No Beauty, for example, we try to pivot and launch things multiple times, and we have not been able to make it succeed. Obviously, it does revenue. It's not like unprofitable by any means, but it's not like a home run, and probably it will make sense to look for another home for that business. It's like doesn't make sense for us. In all transparency, too, we're not in a rush selling Nutrition Kitchen. It's a very profitable business, but it's something we're talking about now. How do we like actually clean up our portfolio and just divest anything where we're not the right owners anymore? Like, can we take Nutrition Kitchen to $100 million in revenue per year? Probably not. I think it's going to require offline. I think we started buying similar businesses in smaller markets. So we're looking at buying something in Taiwan, Malaysia, all these things. These are bolt-on acquisitions instead of pure acquisitions. And we can do that, but like, we're talking about buying 10 companies doing 3 to 5 million each, and the integration work is such a heavy lift. You're probably better off just selling the asset because it's such a crown jewel in Asia, having 90% market share, right? Like, so leave that upside to another buyer. That's great for another buyer, right? Like, leave them meat on the bone. So I think, like, for me, failure is a very loose definition, and like nothing really fails. It's more like, okay, we're not the right owner and we need to kind of sell these businesses. That's how I would classify as failures, where we're just like, okay, we're not the right owner. Let's just like cut ties with this thing. And I think initially I had this like idealistic thinking that like, okay, we're gonna have 10 assets one day, each producing on average 10 million EBITDA, and then have 100 million EBITDA or 15 million EBITDA, right? Like we're gonna have like 10 businesses like Linear and Raycon, right? Like that produce 8 figures of EBITDA. But I think more and more now I realize like probably having 4 to 5 really large businesses, really great businesses, maybe going up into the high teens in terms of multiples that we pay for a business, going more up market where it's less work, might make sense. So if I were to recap like 2024, we made 3 acquisitions. The third one technically is closing in the next weeks, but we started the conversations in Q2 last year. So I kind of say that that's a 2024 deal. So just for full disclosure. So we bought one whale-sized company. So this company does I actually tweeted about it, anonymized. Don't feel comfortable sharing the name yet, just because of the competitive nature of ecom. But it's a $25 million revenue business when we bought it TTM. But what's interesting is it had been declining 3 years in a row by 10% on average every year. So we bought it. We closed the transaction, I think, in July. And at that point, year on year growth was negative 15%, I believe. And we closed the year with 2% growth. We were able in the last like 6 months of the year or so to nullify the negative year on year trend and growth. And it's been an amazing acquisition, right? And I think the EBITDA of the business is north of 4 million. So it's a very healthy size business, and that's an amazing acquisition. So I think we're going to focus more and more on buying companies in that size range with like real durability. It's like been around for like 10 years or something around that. The second acquisition we made was a bolt-on for Nutrition Kitchen. So we bought another competitor in the region, bolted on that revenue. Very small, right? Like it's giving us a 10-20% bump in revenue, but it's meaningful from a EBITDA standpoint because we can consolidate operations, et cetera, et cetera. And then the third acquisition that we're closing now is like out of a bankruptcy where we're buying some IP that makes sense from a portfolio standpoint. So I think for us, like moving forward, what we're going to do is, swing a little bit bigger, try to buy things that are maybe doing 30 million plus, and be willing to, yeah, do less of the value creation work. Because buying something that does 25 million a year, that has been shrinking 10% consistently, that's a very all hands on deck. It's not just like, it's a whole team effort, right? Like it's like Edo, our CEO, Dux, our head of finance, like our whole team is like just being thrown in. We're throwing the whole kitchen sink at it to fix it. So that could quickly become a failure, but became a success basically.
So how many acquisitions have you done in total? How many have you sold? And what about the so-called failed businesses? Do you close them or do you sell them as well?
How many have we sold? We've sold two. We've sold two. And in total we've acquired, I would say nine in total, including like Raycon, Nutrition Kitchen, etc. Like I would bulk that into that, so 9. So it's not a crazy amount of acquisitions. Sorry, I said 10. We've acquired 10, and then we sold 2. The ones that are failing we sell off. So that's one of the 10. And then yeah, I think like This year, I'm not 100% sure we'll acquire something else, to be honest. I'm not completely convinced that we will do that just because of the acquisition we did last July, because I see that brand doing 100 million a year. I can see that getting to kind of Raycon linear kind of scale. So I think just having the team focus on that this year might make sense.
I want to a question about portfolio management and growth. You've said that you have obviously more, but you brought them out three key competencies. Number one, paid acquisition. Number two, influence marketing, and number three, supply chain. Could you cover each and
Yeah,
what makes you
sure.
special?
Take, for example, the company we bought this summer, right? Like, so the founder, incredible founder, he bought the business with an SBA loan when it was doing 3-4 million a year and grew it to like 25 million plus, 3 years ago. And he did that when social media was cheap and when iOS was not an issue. And it was really hard. Like, he didn't know how to run ads. He used an agency. I think the beauty with us is that we have so much scale. So, Raycon alone probably spends $40 million on advertising a year. Like, it's like we're talking crazy numbers, like really crazy numbers, right? And with that scale comes a lot of very good people and a lot of very, very good processes and proprietary systems that we built over the last decade because we've been doing it for a decade. So we're able to bring an all-star team that you wouldn't be able to hire as a small business because our economics are so much better on the group level. We're able to incentivize really smart people with equity, with cash on the group level in a diversified holding. So we get really great talent and really great systems, and we have insider information. We know what to pay an influencer and what rate to pay, and we get bulk discounts. Like, I'll book the same influencer for three brands. So I think all of these things really come with scale and is a function of scale. I don't think we're the smartest people in the room, but we're definitely one of the bigger guys in the room, right? So I think that helps. On supply chain, I'm calling you now from Hong Kong. I live here, and the reason I live here is because I want to be close to product. I think consumer starts with product and is amplified by marketing. And I think it's really hard to scale something unless you have a great product. So, being here in Asia and having an office in Shenzhen, we also have an office in Bangkok actually now. We need to update our website, and we have people in India. Like, we have a large team in India. Allows us to move faster and produce products that are better than a $25 million brand can do on their own. So usually when we come in, we're able to cut cost. We're able to cut lead times. We're able to cut freight costs because we just live here and this is all we do. And we have a big team working on supply chain. So again, scale and geographical location. But like, we spend a ton on influencer. Most people know that. So I think that comes with an obvious win.
You've been honest when it comes to hustle and working too much when you were younger. You're still young, but when you were younger. So how different it is now, you today versus you years ago?
I'm turning 40 this year. I had a big reflection. We were at the beginning of the year, so I did a postmortem on last year. I work a lot less now in terms of hours, right? Like, actually, this January has been really crazy, but like usually I work like a 6 hour day, but it's a highly productive 6 hour day where I get a lot of leverage. So, it's very intense 6 hours a day. Working beyond that, I really struggle because now most people come to me with problems, and that's really taxing. And I think in my younger years, I made up with it with just pure hours and work. So, I put in, you know, worked 80, 90-hour weeks. Even at Rocket, I worked that. And then prior to that in finance. And I think there's a lot of value in doing that in your 20s. I think like working really hard in your 20s is like a very unique period of time before you have kids. But I'm trying to dial it back now. And, the amount of value I create in 1 hour now is exponentially higher than when I was in my 20s for three reasons, I would say. One is like the fact that I have a balance sheet. Two is the fact that I have a huge revenue pool that I can manipulate. So by manipulating 200 million plus of revenue, you can create 7 figures of bottom line. Much harder to do that with like 8 figures. And then three is like just experience and kind of knowing what to do and having legitimacy in the space. So if I call an influencer marketing agency they're going to pick up that call at like 10 p.m., right? Like, and they're going to fly out to meet me when I'm in the US. And that gives me a lot of operational leverage because it just being the most important person with an agency alone, like gives you a lot of leverage versus, 10, 15 years ago.
You've said you had it easy when you started out. I think it's you being too humble, and you've also said that the founders doesn't talk about luck and market timing enough. So my question is there any hope for folks today who start today?
Absolutely. Absolutely. Like if you look at it in the grander scheme of things, right? So when I was born, 1985, the number of e-commerce transactions globally was zero, literally zero. There was not a single transaction in e-commerce. So it's really important to understand is that, I think about that for my two sons, and hopefully, knock on wood, we will have more kids, but the industries they will work in have barely been born. For all I know, maybe my oldest one will work at SpaceX and be on a spaceship, right? Like when he's 40, right? Like who knows, right? Like robotics, longevity, biotech, who knows what's going to come. But the fact of the matter is that I joined an industry right after product market fit, and I was in the top right corner. So I chose to work at Lazada at Rocket Internet before they had a website because I wanted to be in a high CAGR industry in a high CAGR geography. My professor actually gave me that advice. And that's how I ended up at Rocket Internet because I just like, this is going to succeed. I just have to show up, and that's what I did. Like, I wasn't the smartest guy in the room. I just showed up and I was there on day one. I think there's so much merit in that. And, I don't understate this lightly, but like Linear only survived and we were able to start with $20,000 in savings because social media was so cheap. We were allowed to pick the wrong category because it was so cheap. And I think you can be the smartest guy in the room and you will still pick the wrong category often because you over intellectualize things. And you can see it as I do these like mentor pass calls and stuff because it's very humbling. You're talking to kids in their early 20s and they're having this crazy success, right? Like these kids spending $100,000 a day on Meta, they're having this insane success because they were thoughtful about the category and they got lucky picking the right category. And they could have failed, but they picked the right category for the right time. So I think I've seen a lot of surface area for people to succeed in e-commerce still. And I have this enormous privilege where my M&A team is talking to, I think last year we talked to 800 companies or 900 companies, something like that, like in detail, where we got into the financials and whatnot, like high level at least. So we have a very big surface area of seeing what's working or not. And last year I talked to at least 50 people who had an overnight like success. Like overnight, literally like okay, kind of like Raycon, where I got involved, $100 to 20K within 2 weeks. I saw like at least 50 of those cases. So I still think there's a lot of room to succeed. It just requires you to be intellectually honest, which we were not when we started Linear. So if you're intellectually honest today and you look yourself in the mirror and you say, this is much more competitive than when Roman started out, I need to be really unemotional about my category. We were highly emotional about our category. Then I think you're going to succeed. But if you go in with the same mindset that we had in 2013, then I think you're going to fail in today's environment. I genuinely think that.
Today you're getting like 80 to 100 deals per month being sent to you. Is there any downside of like when it comes to building in public for you?
Not really. Like, I mean, if you want to clone Raycon or Linear or any of these businesses, good luck. I mean,
Mm-hmm.
first of all, the TAM is so big. Like Pandora, I think does 4 billion a year, right? Like it's like doesn't really matter if I have another guy doing 50 million a year. That's not really the big whale I'm feeding off, right? Like we're all small fish feeding off a big whale. So I don't really see the downside and never felt the downside. It's definitely a net positive, right? Like so on Twitter, I'll have people like yourself reaching out, prospective candidates, agencies, people who are giving ideas and are very generous with their time. So I find it to be ultimately a net positive.
Okay, two closing questions. What is your favorite book and what's the best investment advice you've ever got?
Favorite book, I would say, is fictional. I'll give you two answers. Fictional is White Tiger. So White Tiger is, I think they made a Netflix movie out of it. I haven't watched the movie, but the book is fantastic. It's about like this taxi driver in India and his rise to power. And the first chapter is really informative because I feel like culturally I can relate to that book, because that's how my father spoke to me. And it's about, he writes a letter to Hu Jintao, which was before Xi Jinping, the premier of China. Um, he says, he talks about this is the era of the yellow and the brown. And he's like very racist in the way he writes it. And it's really hilarious. And it spills over in the whole book. And the book is like gripping from page to page. It's like one of the few books I read from page to page in a day or two. I'm not a big reader. Like I'll read like, for me, like my wife is a big reader. She'll read like two books, one book every other day, right? Like she'll get, it takes me a week or two to get through a book in terms of attention span. But that's a fantastic book and really entertaining. In terms of favorite favorite non-fictional book, I would give actually two books. One is Oil 101, written by Robert Downey. Is it Robert Downey? It's important disclosure. It was written pre-fracking technology. So it's outdated now because fracking changed the oil industry. But it's a really good book, and it's really where I learned how to think first principles. I feel like Elon has now made this like mass, but like and given it a term. But it talks about oil industry. I was trading stocks in my late teens, and I was obsessed with oil. Like I thought, like because I was born in Norway, and that book talks about oil from a very first principles basis, and it's absolutely fantastic because the first chapter talks about the history of oil, which I think is really eloquent because it creates an overstory. And I recommend highly reading that first chapter because it talks about how oil started with whales to make candles and like all the way through. And then it actually breaks down every single piece and component of oil. And I think if you read that book, you should ask yourself, if you wrote a book about your own business, would you be able to break it down to the same level of detail? And Robert, or whatever the name of the trader was, only made money off trading, but he intrinsically understood every single thing, and that's why he was such a successful trader. Let there be, and then the third book is Let There. Yeah, I just wanted to make sure I said the right thing. Let There Be Water. It's a book I picked up when I was in San Francisco. It's a book about how Israel was formed, and when it was a Palestinian state, it was given to and it was a British colony, and Israel was given land by the UN Security Council on the condition that they could find water, enough water to feed to ensure 2 million people were fed water consistently. So that was the mandate the UN Security Council gave Israel, according to this book. I don't know if it's factually true. I'm not a historian, but this book I picked up because I want to work on water and renewable sources and whatnot in my second career. But I think the book talks about Israel's water culture, how irrigation technology and all the water technology has been advanced by Israel and the culture that's ingrained there. And it's a really good book, again, on first principles of water. And I think incredible book. Like you'll definitely turn page by page because it starts with the history and ends with the science. And I think those are my three favorite books.
Okay, and last one. What's the best investment advice you've ever got?
Best investment advice I ever got. I haven't gotten this advice. I come up with it myself. I did the postmortem of last year. So concentration leads to wealth, and I firmly believe that. So I'm pretty public about it, actually. Most of my friends will know, but like 93 or 94% of my portfolio up until July last year or August last year. No, sorry. Up until October last year was Meta stock. And I bought it once it started dipping below 100. My dollar average is maybe 180 and just going very concentrated. So I spend tens of millions of dollars in Meta, and that's how I make money. And then I invest in Meta stock. And the way I think about it is, one, I understand the stock intrinsically really well and the technology, and I'm ahead of the market. Two, it's a leveraged bet on S&P 500. Do I think the solvency risk for Meta is less than 1%? Yes. Insolvency risk is less than 1%, right? But it trades at 2 times the beta of S&P 500. So if S&P 500 goes up 1%, Meta will go up 2%. So it's a way to invest in the US S&P 500 at 2x leverage without having the without potentially being wiped out in the drawdown. So, I think concentration leads to wealth, and I think that's, a very, very big thing. And now I only hold two stocks. The second stock I'm kind of holding close to my chest, but it's the same thesis. It's a platform I spend money with, and I think there's nothing wrong with concentration if you're a founder. But if you're a highly anxious person, the fourth book I would read, which I give to a lot of my employees who ask about how to gain financial freedom, is Unshakable by Tony Robbins. It's a very, very good book. I actually read it the year I went bankrupt. And it talked about diversification. And it talked about how to be unshakable, pun intended. And it's a great book, actually. So depending on your personality, if you have the tolerance, I think concentration leads to crazy outlier returns.
Okay, this is the great way to end it. Thanks a lot
Awesome.
for doing
Thanks,
this, and
Mick.
hope to do it
Awesome.
again
Thank you.
in the future.